If you live in the UK and own Indian mutual funds, here's an important tax rule you should know. Welcome to this explainer, where we're going to completely demystify a crucial and honestly often misunderstood tax rule that catches so many UK residents entirely off guard. Your Indian mutual fund could be taxed completely differently in the UK, and many investors don't realize it. The default assumption for most of us is that when we sell an investment, our gains are just going to be taxed under standard capital gains rules. But when it comes to these specific cross-border assets, making that assumption could cost you dearly. Here is our roadmap for today. 1. The hidden tax trap. 2. The offshore fund rule. 3. Two types of funds. 4. The 45% impact. And 5. Plan before you sell.
Section 1. The hidden tax trap. From HMRC's perspective, many overseas mutual funds are classified as offshore funds. This includes the vast majority of Indian mutual funds. You see, HMRC defines an offshore fund incredibly broadly. It essentially covers any overseas collective investment scheme where you don't have day-to-day control over the underlying assets and you just track your share of the pie via a net asset value. Because Indian mutual funds are structured as trusts, they fall squarely into this definition. They aren't treated like direct shares at all.
Section 2. The Offshore Fund Rule.
The key question isn't whether the investment is in India. It's whether the fund has HMRC Reporting Fund Status. So the geographical location of your asset actually takes a backseat here. What truly matters is whether the fund manager has actively applied for and maintained a very specific stamp of approval from the UK tax authorities. And HMRC enforces this status at an incredibly granular level. They don't just look at the overall asset management company, they evaluate it right down at the sub-fund level. Got a growth option and a dividend option of the exact same fund? Well, those are completely separate entities. Direct plans versus regular plans, distinct funds. In the eyes of the taxman, if you have a diversified portfolio, you're basically running a small offshore empire. Every single holding is evaluated independently.
Section 3. Two types of funds.
Under UK rules, an offshore fund is either a reporting fund or a non-reporting fund. If it does have reporting fund status, gains may generally fall under the UK's capital gains rules. But if it doesn't, gains on disposal may be treated as offshore income gains, which can be taxed at income tax rates depending on your circumstances. That's a very different tax outcome. One lets you use your capital gains allowances, the other basically treats your investment growth as if it were a salary or a bonus. Just look at the sheer penalty of holding a non-reporting fund. The divide is absolutely brutal. With a reporting fund, your maximum tax rate on the gain is currently 24%, and you get to keep your £3,000 annual exemption. You can even offset capital losses from other investments. But on the non-reporting side, your maximum tax rate jumps up to 45%. You are strictly forbidden from using your annual exemption against it. And if you made a loss on another stock, you can't offset it here. It's a highly punitive regime.
Now, here's the harsh reality for UK residents holding these assets. What's really surprising and a bit scary is that currently, absolutely no Indian mutual fund operates with approved UK reporting fund status. Because none of these funds have actively opted into the HMRC regime, they automatically default to the punitive non-reporting category, every single one of them.
Section 4. The 45% impact.
Because your Indian mutual fund is a non-reporting fund, your gains are treated as offshore income gains. And that means they're taxed at your marginal income tax rate, which can reach a staggering 45% depending on your overall earnings. Let's translate that into real-world pain. If you make a £100 gain, a reporting fund leaves you with £76 in your pocket after paying the 24% capital gains tax. But under the default non-reporting status of your Indian mutual fund, you could pay £45 in tax, leaving you with just £55. That is a massive erosion of your wealth simply due to a classification rule.
Now you might be thinking, wait a minute, I pay taxes in India when I sell. What about the double taxation avoidance agreement? It's a great question, but many investors falsely assume that paying the Indian capital gains tax clears them in the UK. Yes, India retains the primary right to tax those capital gains, and you can claim a credit for that tax against your UK bill. But paying Indian tax does not exempt the gain from UK taxation. The UK's offshore income gain rules still ruthlessly apply to your net proceeds. The UK will calculate the tax due at up to 45%, give you a credit for the Indian tax paid, and then demand the difference.
Section 5. Plan before you sell.
Now, there are a few strategies and reliefs available, but they require foresight. For example, if you're a qualifying new resident to the UK, you might use the Foreign Income and Gains, or FIG, regime. This could offer 100% relief on these gains for your first 4 years. But it's a trade-off. To claim FIG relief, you have to sacrifice your UK personal allowance and your capital gains tax allowance for that year. Alternatively, some investors look at deemed disposal elections, or they just avoid the issue altogether by shifting their capital into direct Indian equities, like individual stocks, which are totally exempt from these specific rules. The right planning today could help you avoid costly surprises tomorrow. The absolutely crucial point here is that a tax classification is permanent once you hit the sell button. Once you redeem that mutual fund, you lock in that offshore income gain, and there is no going back to fix it. This makes proactive restructuring essential before you make any trades. Before selling your Indian mutual funds, check how the fund is classified for UK tax purposes. Follow this quick checklist. First, identify every single fund holding and its specific ISIN number. Second, check that ISIN against the official HMRC-approved Offshore Reporting Funds list. Third, calculate your unrealized gains in British pounds using historical exchange rates. And fourth, seek professional cross-border tax advice to model the exact financial outcomes before you act.
As we wrap up this explainer, I'll leave you with this final thought. A high return on paper means literally nothing if almost half of it vanishes to the taxman because of a technicality. Don't judge your investment by its return alone. Know its UK tax status. Do you truly know what your portfolio is going to be worth after HMRC takes its slice? Thanks for joining us, and stay informed.